Another thing we can do is, let's say we go back to 10 as, units per year on average. And let's simulate again, just to get back to the initial values. Right, so again, we're back to similar values. Now, they might be somewhat different. If you recall, right, this is another 20,000 of simulations, but a different sample, possibly. So the values are similar, but not exactly the same. Now, imagine I say, for example, variable costs are not certain. Maybe they'll be 70%, but there could be anything between 60 and 80%. What can I do? Well, it's very easy to add another distribution here. So I can click on 70%, click the distribution, now select, let's say, continuous, and find uniform distribution. There is a uniform distribution, double click. I'm going to remove the statistic, and I'm going to say the minimum is 60%, maximum is 80%, right? So you have a continuous distribution between 60% and 80% with equal likelihoods, right? Click OK on this. Now this is showing us a random value between 60 and 80%. And now I can simulate this system. But if I simulate the system, not only the random demands will be generated, but also the variable cost percentage will be generated randomly between 60 and 80%. It will be generated once for all 4 years, right? If I wanted different percentages, I would have to generate 4 values somewhere here in this table. But I will generate one percentage that is applied to all 4 years. And again, I can simulate this and I can see the impact of this on my NPV. And notice, for example, right, that the mean has not changed much, but the median is now much lower than the mean. So we have a skewed distribution. You could see this, right, graphically here. Looking at this picture, we have a skewed distribution that has a long right tail, right? So this is changing the results. And for example, now the probability that we'll have a loss is almost 26%, right? So this is increasing actually our risk of having a loss despite having a similar mean payoff, right? So we could do the same thing for many other parameters, right? If we don't know if the selling price will be 25,000, or maybe we can charge more or less, we could put a distribution here. Maybe we are not sure about some other parameters like tax rate. Maybe the tax rate can change in second or third year. We could again generate a lot of random effects, and we can, the nice thing about the simulation is that all these random effects can be taken into account in the simulation, and the simulation can run multiple iterations and show us a large right range of possibilities that are all affected by the combination of those random effects.